Hey folks, we have a very important video today, and we're going to talk about the 7 reasons why Wall Street is very optimistic for 2026. And let's just get into it. So, any pullback right now is a massive opportunity. When you look back at this moment 6 months or a year from now, you'll wish that you made the right moves. And why is that? So, 2026 is setting up to be the most extreme market environment we've ever witnessed. And here are 7 reasons for the optimism. Number 1, AI capex commitments hit historic levels. So hyperscalers and governments have committed over $1 trillion in AI infrastructure spending. Projections extending to 2030 reach multiple trillions more. And this unprecedented capital deployment creates enormous opportunities across the AI infrastructure stack. So the key implications here are sustained demand for semiconductors, data centers, and networking infrastructure, multi-year revenue visibility for companies in the AI supply chain, government backing ensures spending continues regardless of conditions, rising tide lifts multiple sectors simultaneously, and that's it for AI capex commitments. Number 2, rate cuts continue through early 2026. The Fed's easing cycle continues well into 2026 and beyond, providing sustained liquidity for risk assets. Lower rates reduce borrowing costs, improve debt serviceability, and make equities more attractive versus fixed income. So, what does this mean? It means cheaper capital for expansion and buybacks, better valuations for growth stocks, increased M&A activity, and housing market stabilization. Number 3, Trump appoints a new Fed leadership in May, and this is very important. The most significant catalyst comes in May when Trump selects new Fed leadership. This represents a major shift from Jerome Powell's slowly ease approach to an administration wanting to stimulate. Trump has been very vocal about wanting aggressive rate cuts, and he'll get appointees who deliver. A more dovish Fed could accelerate cuts, expand liquidity programs, and prioritize growth over inflation concerns. And this is really, really, really significant. Number 4, midterm cycle liquidity boost. So we have midterms, election year dynamics favor credit easing, and 2026 is a midterm year. Trump will be aggressively pushing this with his new Fed appointee. Political incentive to keep markets elevated creates a powerful tailwind. Obviously, if markets are doing well, this can be good for certain political candidates. And historical patterns look at this: increased fiscal stimulus, accelerated rate cutting, political pressure for strong markets, and infrastructure spending and tax incentives. And folks, this isn't speculation. This is just how political cycles function. The difference is an administration signaling extraordinary accommodation. Number 5, multiple expansion as rates fall. So when the Fed cuts rates, equity multiples expand dramatically. People become willing to pay more for the same earnings, even if revenues stay flat, which they won't. Discount rate compression alone drives valuations higher. So a stock at 20x earnings might command 25x or 30x in a lower rate environment with identical fundamentals. So this mathematical reality plays out in every rate cutting cycle. Number 6, Trump's $2,000 tariff checks proposal. Trump proposed $2,000 tariff checks, which are stimulus payments to Americans. Whether or not this materializes, it signals willingness to deploy fiscal stimulus aggressively. And the message here is that the Trump administration prioritizes growth and market performance. Fiscal policy complements monetary easing. Consumer spending stays supported. Asset prices melt up with liquidity injections. So the policy direction is clear. Do whatever it takes to keep the economy hot before the midterms. And yes, this is political, but this is likely what President Trump is doing. Number 7, $6 trillion in sideline cash ready to deploy. Over $6 trillion sits parked in treasuries. So as rates get cut and yields compress, holding cash earning, diminishing yields while inflation accelerates represents guaranteed purchasing power loss. So what does that mean? Not all flows into equities, but even a modest percentage means trillions in buying power. As yields fall below inflation, investors seek returns elsewhere. The setup here is declining yields make cash unattractive. Inflation pushes investors towards real assets. Any dip gets bought aggressively, and massive dry powder supports valuations. So do any of these policies make long-term sense? Probably not. Cutting rates and then throwing stimulus at an economy with assets at all-time highs just creates larger bubbles. But again, we're going to see what happens. Anyways, folks, these right here are 7 major reasons why Wall Street is optimistic about 2026. Stay tuned about further content, and don't forget to like and subscribe if you enjoyed this content. Hit that very beautiful like button, and don't forget, folks, we have a partner Discord that is ZipTraderU with the link in bio. In this Discord, we go over daily stock briefings, much more in-depth chart analysis, daily morning briefings explaining key market drivers, setups, and context, our price forecasts, our top 25 plays, our extreme top 20 high risk, high volatility, high reward plays, all of our ideas and alerts, and daily up-to-date market insights. And all of that is in the link in bio. And remember, folks, none of this is financial advice. Don't do the frisky unless you are willing to take the risky. Peace.